Have you ever wondered how these huge companies borrow millions or even billions of dollars, not from a bank, but from regular people? Well, they do it with something called bonds. And let's be honest, the accounting behind them can seem super complex, but it doesn't have to be. Today, we're going to crack the code on corporate bond accounting and turn this whole thing into something you can actually wrap your head around.
So here's our game plan. First, we'll cover what a bond actually is. Think of it as a corporate IOU. Then, we'll dive into the two competing interest rates that literally set a bond's price. After that, we'll see why a bond sells at par, a premium, or a discount. Then we'll get into the fun part, how accounts handle that price difference over time. And finally, we'll put it all together and solve a real accounting puzzle.
All right, first things first. At its absolute core, a corporate bond is really just a fancy IOU. It's a company's way of borrowing money directly from the public instead of going to a bank. Now, the official textbook definition calls it a formal contract. It says the company has to pay back a face amount on a specific maturity date, and along the way, it has to pay interest at a stated rate. And those three things right there, face amount, maturity date, and stated rate, they're basically the DNA of every single bond.
Let's make this real. Imagine a company needs $1 million, so it issues $1 million worth of bonds with an 8% interest rate. What does that mean? It means the company is promising to pay all its bond investors a total of $80,000 in cash every single year for 5 years. Then, at the end of the 5 years, it pays back that original million. Simple enough, right? Well, this is where it gets interesting.
You see, the entire world of bond accounting, everything about how they're priced, it all revolves around a fundamental conflict between two different interest rates. If you understand this one point, you'll understand everything else.
Okay, so on one side, you have the stated rate. This is the rate that's literally printed on the bond certificate, that 8% we just talked about. It's set in stone and it determines the actual cash payment the company makes. But on the other side, you've got the market rate. This is the real-world rate that's always changing. It's what investors can get from other similar bonds right now. And this rate, this is what determines the price someone is actually willing to pay for that bond today.
So that brings up the big question, right? What happens when the fixed rate a company is offering doesn't match what investors can get somewhere else in the market? I mean, the company can't just change the rate that's printed on the bond. So something else has to give, and that something is the bond's selling price.
This mismatch between the two rates forces one of three outcomes when a bond is sold. It'll either sell at its exact face value, which we call par, for more than face value, which is a premium, or for less than its face value, a discount. And this chart just lays it out perfectly. If the stated rate on the bond is the same as the market rate, great. The bond sells at par, its exact $1 million face value. But what if the company's rate is higher than the market rate? Well, that's a great deal, so investors are willing to pay more for it. The bond sells at a premium. And you can guess the last one. If the stated rate is lower than what the market's offering, nobody's going to pay full price for it. It has to sell at a discount.
It really just boils down to this one simple idea. The bond's price has to adjust up or down to make sure its total return matches what the market is demanding at that moment. It's a really logical system once you see how all the pieces connect. Okay, so a company might get more or less cash than the bond's face value. How on earth do accountants deal with that extra premium or that discount? I mean, they can't just call it a one-time profit or loss, right?
Exactly. Instead, that difference has to be spread out, or as accountants say, amortized, over the bond's entire life. And what this does is make sure that the company's financial statements, each and every year, show the true cost of borrowing that money, not just the amount of cash that went out the door.
The standard way to do this is called the effective interest method. And this formula right here is the engine that makes it run. The true interest expense for the year isn't the cash paid out. Nope. It's the bond's value on the books, its carrying amount, multiplied by the market interest rate from the day the bond was first sold. Let's see this in action with a premium. So in this case, the company offered a sweet 8% rate when the market only wanted 6%. Because it was such a good deal, they got extra cash up front. But their true interest expense is calculated using that lower 6% market rate. You can see it in the table. They pay out $80,000 in cash, but the real expense is only about $65,000. That leftover $15,000 gets used to slowly chip away at that extra premium they got, bringing the bond's book value down over time.
And for a discount, it's the exact same logic, just flipped on its head. Here, the company offered 8% when the market demanded 10%, so they got less cash up front. This means their true interest expense is actually higher than the cash they're paying. The table shows they pay out $80,000, but the expense on their books is over $92,000. That difference gets added back to the bond's value each year. In both situations, the goal is the same, to get that bond's carrying value on the books to move step by step right back to its face value so it lands there perfectly on the day it matures.
All right, that was a whole lot of theory. Let's make this really concrete. We're going to take a problem straight from our source material and we're going to solve it together, step by step. Let's do it.
Okay, here's the setup. Evangel Company issues $100,000 of 9% bonds, but the market rate at the time is 10%. So naturally, they sell it at a discount for $96,207. Now the big question is, what is the interest expense that Evangel should report for the second year? So how do we figure this out? Let's just break it down. Step 1. We calculate the interest expense for the first year. We take the initial book value times that 10% market rate, which gets us $9,621. Step 2. Let's see how much of the discount we've accounted for. We take that expense and subtract the actual cash paid, which is $9,000, and the difference is $621. Step 3, and this is the key. We add that $621 back to the bond's initial value. That gives us our brand new carrying amount for the start of year 2, $96,828. And for step 4, we just rinse and repeat. We take that new amount and multiply it by that 10% market rate one more time, and that gives us our final answer.
The interest expense for the second year is $9,683.
And if we jump back to the original problem, there it is. Our calculation was perfect. The correct answer is D. You see, you just solved a pretty gnarly bond amortization problem. Not so bad when you take it step by step.
So let's quickly recap the most important things to take away from all this. First, a bond's selling price, whether it's at par, a premium, or a discount, is all decided by that battle between its stated rate and the market rate. Second, that premium or discount isn't a one-time thing. It gets spread out or amortized over the bond's entire life. This whole process adjusts the interest expense to show the real cost of borrowing. And finally, all of this makes the bond's carrying amount on the books march steadily towards its face value, hitting it exactly on the maturity date.
So we've gone through how all the rules work. But that brings up a really interesting final thought. We know a premium lowers the reported interest expense and a discount raises it. So how could a savvy company maybe time its bond issues to help manage its reported earnings for a particular year? It's just something to think about.